With all the math and jargon, getting into finance can seem daunting at first. Hey, just got the IRR and RVPI numbers back from the GP. Oh, which GP? Oh, from the LBO fund. Great. Hey, the PM wants us to contact the prime and enter into a 200 million notional fix for floating because he's worried about a bear steepener with our duration risk. Yeah, how about that? That doesn't sound like insane, made up nonsense at all. But you can start growing an understanding of it pretty quickly, starting in the right place. And one of the most fundamental places to start is with the different types of assets and the asset classes. The type of asset most people interact with the most is cash. And cash isn't just coins and bills and checking accounts. There are also cash equivalent assets, something that I'll discuss more further in the video. Next we have equities, or stocks, or stonks. These represent ownership shares, usually in a business that's made up of assets minus liabilities. Publicly traded companies issue these ownership shares of themselves that are traded on public markets. Bonds are fixed income debt securities, which make up a much larger market even than the stock market. Investors can buy bonds to be paid back with interest at future time periods, or to trade on appreciation or depreciation of the bond itself. Now, options are a bit more arcane. They're contracts that give the holder the right to buy or sell an asset at a predetermined price, by or at a predetermined date. Now imagine this premise. Shiny rock prices are going crazy, but if you pay me $10 now, then I promise that for the rest of the year, you can buy one shiny rock at $100 no matter the market. Now we have forwards and futures. What's the difference? Well, if you remember, forwards are forward in time, and futures are in the future, that won't help. I will go into the differences and the nuances between the two at a later time from now. They're quite similar contracts which set a specified time at which a good will be traded at a specific price. Like, how about I sell you 300,000 pounds of walnuts for $3 a pound in 1 year? Commodities are physical goods like metals, crops, oil, wood, often ones that are used as inputs in the creation of other goods. They're often traded using futures contracts, however they can be bought and sold directly on the spot at what is called the, spot. Well, I guess everything else has been fake, because now we have real assets. Real assets are physical. They're things like infrastructure and buildings. The type of real asset that people have the most experience with is real estate, and these are things like residential homes, and also apartments, offices, retail space, warehouses, storage facilities, and things like that. I will also touch on alternative investment strategies, which might include private market transactions, either in these assets already mentioned, or specific strategies that might combine these asset classes. Common investors in this space would include hedge funds, private equity, private debt, private real assets, and I'll have future videos dedicated to each of them as well as specific different types of hedge fund strategies. Cash is generally the most liquid asset class and typically exists in the form of national currencies. Currencies are issued by governments as a medium of exchange and may be pegged to other currencies or backed by physical assets. In the US, the form of cash most people generally interact with is the US dollar. On its own, cash does not offer a return relative to itself, as $1 US will always equal $1 US. Return may be obtained by purchasing cash equivalent assets. The most common example are short-term debt securities issued by the US Treasury called Treasury bills or T-bills. Since they're highly liquid and mature quickly, they are generally considered low risk and with that offer low returns, following closely around the Fed funds rate. You might see money market accounts at a bank, which offer a return. Banks invest in T-bills and similar cash equivalent money market securities in order to generate the needed return. To raise capital, a company might decide to go public, issuing ownership shares on the public market. Investors can buy these shares and receive a fraction of ownership of the company, which may include the right to cast votes on company decisions. Equity ownership comes with risk, however. as a business might do well, fail, or anything in between. Since stocks are regularly traded, they are subject to price fluctuations that may be meaningful in response to new information or might just be random noise. Since stocks are riskier, investors generally demand a greater expected return for holding them. These gains can come from dividends companies pay to their shareholders or an increase in the market price of the stock. Many investors invest in stocks in the form of funds, which own many companies and issue shares of the fund as a whole. Common forms these funds take are exchange-traded funds, mutual funds, and commingled funds. Bonds are debt securities where an issuer sells these bonds, offering future interest payments. The owner of the bond receives payments called coupon payments until the bond matures. Bonds trading freely on an open market may fluctuate in price as conditions change, like interest rates or the perceived likelihood that the issuer will not be able to pay back what they owe. A bond's yield is the percentage return that a bondholder will receive per year relative to the amount paid for the bond. For example, a 10-year bond paying 5% annually bought for $100 might pay the owner $5 a year, then $5 plus the initial $100 in the final 10th year. There are many different ways that a bond might be structured, and there's some math involved in understanding them. I'll follow up with further videos dedicated solely just to the topic of bonds. Although different option contracts and contracts with optionality can differ widely, there are two broad types of option: a call option with the right to buy, and a put option with the right to sell. A call option is a contract where the buyer of the option purchases the right to buy an asset at a set price by some set future date. An example would be buying the right to buy 100 shares of stock ABC within the next 3 months at $100 per share. If stock ABC trades above $100, say 110, then you can now buy the stock for less than it's selling for, paying only the 100, being profitable for you. A put option gives the buyer the right to sell an asset at a set price by a set date. An example of this would be the right to sell 100 shares of stock ABC at $80 per share. If the stock trades for below that, say $75, then you can sell it for more than it's selling for in the market, being profitable for you. Options can be very nuanced and can be tricky. There are a large number of strategies that employ them, and I will discuss options quite a bit more in future videos. Forwards and futures are contracts which set a predetermined price and time at which an asset is agreed to be traded. An example of this could be where Dude A and Pal B enter into an agreement where Dude A will sell 100 pounds of oranges to Pal B for $100 in 1 month. There are different ways in which these contracts can be settled, with some of them ending in the purchaser of the good physically taking ownership of the good at the end, and some being settled in a cash exchange, where the net profit or loss is exchanged between the parties, as if it were traded. Futures don't only have to be used for physical goods. There are also futures on bonds, stock market indexes, the Fed funds rate, amongst others. And here we start to get into mark-to-market and daily revaluation of futures, which I will get into in future videos that I'll make in the forward from now time. The key thing to remember about futures is that they're an agreement that pre-specifies a trade that will happen in the future. Commodities are physical goods like grain, lumber, livestock, fruit, coffee, sugar, chocolate, metals, and others. They can be traded directly, but are often traded using futures contracts. Commodity prices are closely tracked, as many of them are used as inputs in the creation of other goods, like wood used in the creation of houses, or sugar being used to make cookies. When investing in and trading commodity futures, there are a number of nuances to pay attention to, like the shape of the slope created by the futures prices over time, which introduces roll strategies. The nuances of commodity futures are something that I will get into in future videos, but for the purposes right now, it's sufficient to say that commodities are physical goods. Real assets are physical and encompass things like physical infrastructure and real estate. Real assets are often traded in private transactions, with the most common example being people purchasing homes. There are also private real estate funds and publicly traded real estate funds called REITs, real estate investment trusts. In a REIT, a fund manager purchases properties like offices, stores, storage centers, apartments, and aims to generate a return for its investors, either by charging rent or for selling them later for more than they were bought for. There are a number of strategies that have come to dominate a huge chunk of the market in just the past few decades that invest in alternative strategies which might combine to assets that have already been listed. Private investment partnerships, structured as limited partnerships, are a way for investors to be able to invest in assets that aren't traded on public markets, and also to potentially benefit from skilled active managers. In a private investment partnership, investors are limited partners who commit some set amount of money for an investment fund to use over some set period of time, with a typical lockout period being around 10 years. In this arrangement, the fund is the general partner. The fund, general partner, takes the money, then uses it to buy assets. After some time, these assets are sold, and the fund distributes the return back to the investors. The three main types of private fund are private equity, which buys or invests in private companies, often becoming directly involved in their management; private debt, which offers loans and financing or purchases already existing debt; and private real assets, which invests in real assets like real estate. Hedge funds can be real dull, or the most exciting and interesting funds out there, and really everything in between. There's no real set way that hedge funds invest, and they can employ many different investment strategies across public and private markets. They're generally also structured as limited partnerships, like private funds, but typically without the long periods where investment capital is locked up. There are many broad strategies that hedge funds use: equity market neutral, long short, managed futures, short only, statistical arbitrage, event-driven, global macro, and many more. Really, if you can think of a strategy that makes money, it could possibly be a hedge fund. So that's a general overview of the sorts of things that are in the financial ecosystem. They all have their own nuances and quirks, and can take time to get to know, but just knowing what they are is a major step in getting to understand finance. So I hope you found this useful, and was a good jump into finance, and follow if you're interested in seeing more as I go deeper and deeper into all of this. Then please do subscribe, because I'm just gonna keep going deeper. And have a most excellent day.